So good morning and welcome to the latest episode of MoneyWise UK. I'm George, your host, and I am genuinely delighted to welcome back David Jane of Premier Miton. David was, I would say, my first guest on a podcast I did, and so it's a real pleasure to kind of have him back. And I want to dive back into this big topic of natural income, which was the conversation we had 12 months ago. But also I want to kind of look at it in light of a recent episode that I did where natural income was described as bonkers. And hopefully that will spur David on to have some thoughts around that. So I want to kind of unpack that. I want to explore where natural income fits in modern retirement planning. I want to consider whether it's kind of outdated, whether it perhaps is misunderstood, or is it actually the kind of missing link in how we design sustainable income strategies. So welcome, David, today. Thank you so much for coming to join us. So
yeah, hi, George. It's great to be here.
Oh, no, it's brilliant. It's really good to have you back. And I think from when we first spoke, I've kind of slightly changed. I have these kind of warm-up questions. So they're my testing questions for people.
Yes.
So for those who don't know you, can you perhaps just give us a quick overview of your career in financial services?
Yeah, well, it's difficult to do a quick one, actually. But, I've been in this industry for some time. Started at a small life company, moved on to a sort of fast-growing retail house, then back to the life industry, then back to the retail side of the business at M&G, where I spent 10 years, probably the place where the advisor community most knows me from. Subsequent to that, I set up my own business, Darwin, which we sold to Miton, which then itself was sold to Premier. But the fund that is Cautious Monthly Income that we probably mostly want to talk about today is the fund I launched at Darwin in 2011. So it's now got a huge track record, actually, which I'm somewhat proud of.
And kind of, if you hadn't gone into finance, where do you think you'd be today?
Well, deep down, Georgia, I'm a geek. I'm a bit of an academic and a maths freak and so on and so forth. These are the things that motivate me, actually, which can be annoying to others. But if I hadn't got so greatly distracted while at university, I think I'd have probably gone on to study further and stayed in academia, to be honest. But I did get rather distracted at university.
And didn't stay in academia.
Probably for the best.
You could go back to it, maybe? No.
I don't think they'd have me.
No? Okay. That's fair. And do you have like a favourite book? And if you do, why has that stuck with you?
There's particularly in finance, there's so many interesting books. But the one that stuck with me in finance was Misbehaviour of Markets by Benoit Mandelbrot, who was an academic mathematician who took an interest in financial markets. And he sort of debunked pretty much everything I learned at university about finance. And, basically came out with the fractal theory of markets. If you understand fractals, but they're a sort of natural pattern that you see in nature all over, and it's a mathematical repeating pattern. And he then applied that to financial markets and discovered that basically equity markets behave in a similar way. People assume that they follow a normal distribution or a random walk and this, that, and the other. All of that is utter bunkum. And if you actually look at the maths that sit behind how markets behave. Now, understanding that perhaps doesn't have necessarily a huge amount of predictive power, but it really helps you understand risk and very much perhaps helps you understand how trends always persist in financial markets. So it's a very powerful book if you can dare to get into the maths in it.
As I say, I suspect you have to be very good at maths to understand some of the theory behind it.
But it's probably not a layman's read.
Okay. And is there something about you that you're prepared to share that not many people know?
I spent a lot of time today thinking about that question, and I I honestly think I'm quite an open person. So I think most people know most things about me. But I think one thing that perhaps they don't know is I've been in this industry 38 years now. Something I probably don't know about myself, actually. I was quite shocked when I was thinking about that this morning and you asked me about my career and what I've done over these years. It's 38 years been doing this.
A long time, isn't it? It's
yeah.
I think
moment.
I started financial services in 1988. So
wow.
Yeah.
I'll beat you there.
Yeah. And I think how much has changed as well in that
Yeah.
period. It's quite incredible as well, isn't it? So
And how much has stayed the same as well. You know?
Yeah. And I think that kind of leads on to the kind of the debate around natural income, because I know we've talked about it, and I think your view is really, really interesting, which is why I'm really pleased to have you on here. But if we start kind of from a simple basis, and perhaps for those who aren't familiar, can you kind of explain what exactly natural income is?
Yeah. And it's amazing, George, that we actually have to do that these days. You know, we're talking about my career. I was at Newton, you know, we were a big income house. I was also at AXA, you know, we had Jim Stride, you know, the big income guy. M&G was obviously a huge income house. And back in the early part of my career, I would have said everybody understood income. You know, they understood that equities pay dividends every year, sometimes 4 times a year, and that bonds pay you a coupon quarterly, and so on and so forth. And therefore, that you were investing, you know, and you would receive an income stream from those investments. And that's essentially what income is. It's like the interest you get on your deposit at the bank. It's more vulnerable, more risky, but it grows over time. You know, in the case of equities, equity dividends grow over time, typically around the rate of inflation, if not higher. So that's what natural income is. You know, if you have a portfolio, it should be generating some income over time.
But it's true that kind of natural income fluctuates from month to month. And I guess for some people, it depends how you look at it, is that in a way, I guess my question is, how can that kind of help or maybe hinder someone who's managing their retirement income? And is there kind of a better way to look at it? Because obviously, if you've got, you know, £100 coming in 1 month and 200 next, it's quite difficult, isn't it?
This is the challenge, and there are a number of ways of addressing that challenge, George. But firstly, the income on your bond portfolio doesn't fluctuate month to month. I mean, if you're directly invested in bonds, you'll only receive the coupons quarterly. But if you're invested through a collective, you can receive that income daily if you so wanted to. And it's an income. The income on equities is seasonal, and it does vary considerably month by month. If you own your own portfolio, you can manage that simply by allowing cash to accrue in the portfolio or holding a cash balance. A lot of advisors do that who use income strategies or you know, unit encashment strategies. They hold a significant amount of cash in order to smooth the income across the year. Or you can own one of the small number of monthly income paying funds that try and pay an equal monthly payment. One way or the other, you know, you're broadly going to get the same outcome by smoothing it yourself or smoothing it through a collective. What I would suggest is that if you're smoothing it through a collective, you're remaining fully invested. Holding cash is obviously a drag on total returns over the long term. So, you know, you should probably get a slightly better outcome if you use one of the collectives, but it's very much up to people's own choice how they do that. But you know, it's not as volatile as you think as well. That's another point I would make. You know, I've been looking at my income forecasts, as I do every day, but particularly today, and how relatively bumpy it is over the course of the year. And it's because we're globally broadly invested, and because we're a portfolio mixture between bonds and equities. Even if we paid the full amount out each month, the volatility of the income stream wouldn't be so great. But I try and smooth it so it's equal payments.
And I guess that's the thing for many people is that if they're buying a fund and it's paying a monthly income, then they know that that's what they're going to get, and that's what the fund manager is trying to achieve, isn't it? But obviously, if you're trying to manage it yourself, then, as you quite rightly say, then you've got to kind of work out a way of smoothing that and ensuring that you don't get that fluctuation. So I guess that's what people need to think about when they're looking at that, and that kind of goes on to this kind of, I guess you've got this real, I guess income. It's interesting what you said is, I guess when I started in the industry, we sort of understood what income strategies were. And I guess we've now got, I was trying to work out the age of people who would have to have come into the industry before 2008. But yes. we've got this kind of group who have come in, or who only really know the industry from 2008, 2009 onwards. And you've got this kind of feeling that the only way to make money, in inverted commas, is through growth strategies. And I guess that's probably where this sort of polarization comes from, in that if you talk about natural income as a strategy, there are some people who are very negative about it. And interestingly, the conversation I recently had on a podcast was, it was described as bonkers. From your side, how would you respond to that?
Well, do you know what? The critiques fall into a number of valid and bonkers critiques, because ultimately, at the end of the day, it comes down to whether you're able to achieve a similar or better total return than a total return strategy with an income strategy. And if you can and are, the income strategy is always going to be less risky. That's what it comes down to. Because if you're only ever drawing the income out, and if you're pursuing a growth only strategy, you need an estimate of what the future growth rate is going to be. And, in 38 years, the one thing I've learned is it's not really possible to predict the future. And so in my view, you are taking something of a huge risk by pursuing those a pure total return strategy, because you simply do not know what the safe withdrawal rate is going to be. If you're pursuing an income strategy, it's there on the face of the fund. You can see what income is coming out of that portfolio, and that income you can reliably assume is going to either stay the same or grow over time. Yes, there may be some volatility, particularly if your manager's not actively managing the income, or so on and so forth. And that ultimately is the nub of the argument, as far as I'm concerned. The criticisms, they fall into sort of two camps. There's the bonkers criticism, and I think that sort of basically fails on its own merit. If you actually look into that with a rigorous mind, you can see that that's not really a valid argument whatsoever. And then there's the more valid criticisms, and the more valid criticisms fall into the camp of income strategies underperform. We've seen this 17-year period where a lot of income strategies have underperformed. As I say, I've been running my fund since 2011, and it certainly hasn't underperformed, because you do not need to just own income shares in an income fund. That is one of the complete fallacies about income strategies, that they only buy high-yielding UK stocks. No, they don't have to only buy high-yielding UK stocks. Their largest holding can be Meta if they so choose. And so that's an invalid criticism, but it's one based on fact, which is an awful lot of income strategies have ignored huge swathes of the market to the detriment of their clients' outcomes. This didn't have to happen. It was a choice that some income managers pursued. And I think the criticisms there are quite valid, but they're only valid across a limited number of funds. The same about the income volatility. argument, again, it's not altogether valid, but it is valid in the case of a lot of funds. They haven't successfully looked after their income stream. They've ignored it, chasing total returns and often underperforming. So I think, there's the intellectual arguments, which really just come down to what's the safe encashment rate and what are future total returns are going to be. There's a lower risk approach, which is look at the yield and the income the portfolio is generating, or there's a high risk approach, which is guess what the future returns are going to be, often based off very poor maths based on past returns.
And I guess it kind of, you've sort of covered this a little bit, but I guess it's kind of digging a little bit deeper, is that why do you think some advisors and investors are big fans of natural income while others view it as outdated or even risky? You touched on it. It's like you've had that such good performance, haven't you, of growth strategies, I guess, and maybe kind of a change in the way that people have managed income strategies, maybe. I don't know. Do you have any thoughts around that?
I think, obviously I see an awful lot of advisors over the course of a year, and some of them have clearly had their fingers burned. A lot of the, I suppose, traditional income strategies that people have used in the past went off the rails in one way or another. And that obviously discredited the whole strategy, when actually it wasn't a problem of the strategy, it was a problem that the managers didn't adapt to the changing conditions in financial markets. So whether it was UK equity income strategies that had a very poor run, obviously one of which blew itself up spectacularly, and so on and so forth, or whether it was mixed asset income funds, I'm in the mixed asset space, and that, a lot of mixed asset income funds who perhaps rightly or wrongly in the 80s, 90s and 2000s concentrated very heavily on UK equities because they were strong dividend payers, very consistent, but also were outperforming. If you think, from year 2000 up to 2008, UK equity outperformed, and quite considerably, and the US underperformed. And so, they stuck with that strategy, which of course in the last 15 years has been very poor. And they didn't adapt. The market in the last 15 years is quite different to what it was back then. And if your income strategy is still sort of sitting there with huge amounts of UK equity, has never looked at Europe, Asia, or the US, has not embraced the need to own growth in a growth-driven environment, then they will have underperformed, and it's discredited the whole strategy, and it didn't have to be the case. And I think, those advocates of income strategies, many of whom themselves have adapted over time and use more modern income strategies nowadays, have had it right all along, frankly.
Do you think that to some extent we need to start reframing the discussions, much less focus on natural income and perhaps more on sustainable income, or kind of total return planning, or I don't know. What are your thoughts around that?
Yeah, I sort of get what you're saying there, George, because the phrase natural income sort of came about as a quirk of history, really, when you think about it. If you go back in time, people just talked about income. But it was just income, what income is my portfolio generating? And if I needed more money out of the portfolio, then I'm selling some of the portfolio. And that was clear. And then, with the rise of platforms, so on and so forth, them only enabling unit encashment, so on and so forth, advisors have got into the habit of telling their clients they're receiving an income when actually they're not receiving an income at all. They're just selling their investments and giving them the money back. And that's a very different thing. It's, if you're spending your capital, you're not spending income, but it was called income. And that was, so, the income advocates came up with the phrase natural income, which then requires some explanation. But I think you're right. We need to reframe the debate, actually, because the debate actually does come down to the nub of the matter, which I mentioned earlier, which is what is the safe withdrawal rate, around which, how much is your portfolio generating in terms of natural income, and how much are you eroding the capital through selling units? Now, it's fine to erode the capital because many clients will be expecting to erode capital over time. And that's perfectly fine. But how do you know what the safe encashment rate is? Know that you can have a model-based approach or you can have a fact-based approach. I'm a fan of the fact-based approach.
I think that is a difficult one, isn't it? Is, you have that magical figure of 4% that some people argue is dated, and but I guess you've got to have a guardrail to start with, haven't you? You've got to start somewhere. Do you? I guess one of the things, and I'm going to kind of pick up on that in my next question after this one, but do you think it's fair to say that we need to kind of think that it's not a binary choice between income or capital withdrawal, and that, I've kind of said the best strategy is often a blend between the two, but I guess what I'm trying to get there is that ultimately it's whatever is right for the client, isn't it?
Well, quite, and every client is different, and this actually, just picking up on something, I'm looking at my screen here. The UK 30-year gilt yield is over 5%. And people are still talking about a safe withdrawal rate of 4%. They've been talking about a safe withdrawal rate for as long as I can remember of 4%. This number does never change because it's based on past long-term averages. But if you were, 60 odd today, you could just live on the income on the 30-year gilt for the next 30 years and get 5 and a bit. I mean, that's the problem with these safe encashment rates. They're based on past returns. They don't look at the screen. I can look at the screen and I could give you a zero risk portfolio, which gave you 5 and a bit over the next 30 years, and you'd never touch a penny of the capital, and you'd still have your start capital at the end, which the government will give you back. And that is, but going back to your question, clearly a huge number of clients will need to encash units over time. They will need to erode their capital. Some fortunate clients will be able to live on solely the income out of their portfolio, and good for them. Some very fortunate clients won't even need to spend all the income in their portfolios, and hurrah for them. But every single client is different, so you need to construct a different portfolio for every client. That's where retirement planning comes much more complex than an accumulation phase, and that's what an awful lot of advisors are grappling with now, which is why the complexity of thinking about income and capital withdrawal is just another additional frustration for the advisory community. But it's the reality of post-retirement planning. It's more complex.
And it's funny, actually, just listening to you talk about that and the whole 4% figure. And you can see how financial planners, and even if individuals want to do it themselves, how that's really difficult to work out what that figure is, because it is based on the past and you have no idea what the future is, and trying to guess it is really, really hard. And I guess this is one of the questions I've got here, which I noticed in all of this. I do want to ask you a little bit about your strategy as well, so I will come on to that as well, because I think that'd be quite helpful for people. But I guess it comes on to this, is that if you go for an income strategy that is, we'll call it natural income because people recognize that, but if you've got a natural income of 3.5% and the client needs 5%, I guess the only way to bridge that gap is by selling down units, isn't it, really? Or find a strategy that pays a higher yield, I suppose.
Well, quite. And it really is, if your portfolio is only generating you income, and obviously we've got charges to take into account and fees and so on and so forth, but 3.5 doesn't seem very much. When you can have a very conservatively managed bond portfolio yielding certainly over 5 today. And, there's plenty of equity income out there. And I think that perhaps the problem is people haven't actually considered the income on portfolios when they're constructing portfolios. But yes, most people are realistically going to draw some income and erode their capital to some degree. That's the way it is. And that's unfortunately most people, well, fortunately, unfortunately, because there's a trade-off there, isn't there? Are not going to have enough income out of their portfolio, but they would have had a better lifestyle on the journey up to retirement.
Yes. And yeah, I mean, I read, can't remember where it was from, but there was some really interesting research which was kind of showing how income drops, and it's expected to drop a lot further as we get to retirement. So the difference between what our income is before we retire and after is dropping significantly, and at the same time the amount we're putting into our pensions or is falling compared to where it was in the 70s. So I think that's a separate debate and a worry, isn't it? Is how do we get people to put more into investments? And if you talk to a 20-year-old and you say, well, actually you should be putting in £200 or £300 a month into a pension, all they're interested in is, if they want to buy a house, all they're interested in is putting the money into a deposit on a house. And so you've got those kind of different dynamics, haven't you, to kind of think about as well now.
And I throw into the pot there, well, firstly, you've got a huge amount that youngsters are paying in rent these days, but then we were paying double-digit interest on our mortgages back then, so it's a bit of a trade-off. But at the same time, I think the realization that the government's not going to be there for you in 20 or 30 years. I mean, I think it's becoming increasingly clear to people that that the nature of our demographic means that the value of state benefits in retirement is going to be declining in real terms. That's an inevitability going forward, unless we can increase the tax take on a shrinking working population, which seems implausible also. Yeah. So there's a battle between retirees and the working population that's going to take place in the next decade or so. And I wouldn't want to be gambling on how that pans out, so I think we increasingly need to know that we have to support ourselves in our retirement.
Yeah, and I think that's where it becomes difficult, is how do you do that? And before I kind of ask you about your fund, I want to ask 2 questions around, and anyone listening to this may think, oh, well, I'm pushing on a natural income, but I think it is important that we cover these. So there's this talk about sequencing risk, and this is kind of where markets fall and when you're taking income from your pot when you take it, etc. So kind of in volatile markets, does natural income protect against sequencing risk, or can it actually make things worse?
I think it's neutral either way, because the key, I mean, you could make a strong argument that natural income is a lower risk strategy ultimately over time, because it tells you how much to draw. And the problem with sequencing risk is where you set up a unit encashment strategy with a too high withdrawal rate, markets fall away, you're encashing units. Obviously, your pot runs out rather too quickly. Which is, if you were using only a natural income strategy and you were to set up at exactly the same moment in time a natural income strategy, the natural income on your portfolio would have been lower than what the unit encashment strategy told you could safely withdraw. And that is where that argument sort of, obviously the 2 strategies are neutral, but you don't know how how much to draw out of your unit encashment strategy. And that's why natural income is a lower risk strategy for withdrawal than guessing what the safe encashment rate is, because you don't know what future returns are. But if, for example, at the top of the market, the yield on a natural income strategy was 4%, or say let's call it 3%, and unit encashment strategies always say 4 is safe, well, it's suggesting the market's 25% overvalued, and you're going to experience that drawdown at some point. Try to encash 4% of the units, becomes 5, 6, 7, and you get hammered. Whereas if you're just drawing your 3% income out, you're never going to be experiencing that problem. And it's about what you expect future total returns are going to be. That's where sequencing risk really is the argument. And, it ultimately means natural income is a less risky strategy simply because it's giving you a guide as to how much you can draw out.
But then I guess you've got this other side, haven't you? Is that if we rely on natural income and dividends are cut or bond yields, I always get this wrong, bond yields fall, then you've got the argument as well, how resilient is the strategy? Because if I'm relying on it to pay me 5.5% and everything, they get cut, everything falls, also my 5.5 is 3%. So surely I've got that risk that's going to happen.
Yeah, you can, addressing the dividend issue first, over time dividends grow. Sort of end of story. There are times when dividends have fallen for a short period of time and regained their peak. It's up to the manager to manage through that. He shouldn't specifically be buying stocks that cut their dividends. That's a poor strategy, and it should be feasible to manage through it. I mean, even if you look at 2020, which was just a total horror for an income manager, we came through that with a sub 2% decline in the overall distributions in the year, which is pretty satisfactory as far as the clients were concerned. You can manage through the periods of income loss and still participate in the upside of markets when they recover. So I think that's down to the manager and his determination to deliver the outcomes clients want to receive. In the case of bonds, it's a double-edged sword, because when bond yields are falling, you're making capital returns on your bonds. So you've got the capital gain to reinvest. Now, it's the reinvestment rate where your challenge lies. Obviously at the moment with bond yields rising, I'm reinvesting maturities at higher yields than I bought the bonds that matured at. So that's attractive. Obviously, I need, in a period of falling bond yields, I need to own longer duration and get the capital gains and reinvest those capital gains. And so again, it's down to the active management of the income portfolios. It's why basically passives can't do income. You have to be on top of the income and actively managing it. And managers have made some terrible errors in the past.
And I was going to ask a question, but I think we've already covered it. So I'm going to skip that one. So the question I was going to ask you, anyone wondering was whether we should retire the term natural income entirely. But actually what I'm really interested in is just listening to you, perhaps just to give you an opportunity to just talk about your own strategy and how that operates and what you're trying to achieve. Because I think listening to you going through this and thinking about it as income rather than natural income, but let's think about it as income. And you've also talked about how, it's okay to have holdings within that don't pay an income. It would be really interesting to kind of get a little bit of background as to your strategy, how you think and what you're trying to do as well. And also, for anyone listening, we had a conversation before and you were sort of saying, actually, you look at it on a constant basis and you can't really just hold cash, as cash comes in, yes. You can't hold it. So really interesting. It's just to get a flavor or a feel for your strategy, if you can.
In my heart of hearts, I'm a total return fund manager. I'm not naturally an income manager. I've had a lot of exposure to income managers across my career. As I said, variously at Newton, AXA, M&G, so on and so forth. And I've come across a lot of income managers, and I've seen the strengths and weaknesses of the strategy. But when I moved into mixed asset management, I became, very much a total return fund manager, and with an eye to the downside. And it's only, in the last decade or so that I've been running income strategies. My philosophy has always been outcome driven. What is the outcome the client's going to receive? One of those is obviously income. So I've applied that total return strategy to an income strategy. And when we thought about the income strategy, it was very much, what do clients actually need out of an income strategy? What they want is a regular, reliable, consistent monthly payment. And they need that to grow over time. If they're going to be retired for 30 years, they want to see that to grow around in line with inflation. So that's how we set the fund up, very much so. And in order to achieve the growth, you've got to have total return. You absolutely have to. So, we set the start level of income, and we look at the level of income we're paying out. Is that consistent with being able to grow that income over time? Now, as a total return manager, I'm not just narrowly focusing my stock selection strategy around high yielding shares by any means, because there's some good ones, there's some bad ones, and we don't want the bad ones. At the same time, I'm a total return manager, and you can make some spectacular returns out of companies that don't pay any dividend at all. We need that. And I basically, so in a sense, there's three categories of equities you might buy in a fund like this. There is the classic income managers, high yielding shares. It must be cheap because it's got a good dividend yield, as you can probably understand. I'm relatively cynical about that, but on occasion it works extremely well as an indicator of this. These shares are extremely undervalued, and it does help me buy deep value situations. That's good, but it can't be the core of the portfolio. You can look for those really consistent, always grow their dividend sort of stocks. We like those. We're going to have some of those in the portfolio. Typically, they're not the cheapest things ever, but when we can find them at attractive yields and they grow their dividends every year, we'll have those as well. When we're out buying growth stocks, we're buying them solely for total return. We know they're not going to contribute to the income, but in reality they are. And the reason in reality they're going to contribute to the income is because we run a very disciplined portfolio construction strategy. Say we've put 1% into a growth stock and it's up 30%. I've got that 30% to sell, and I can reinvest it in an income. And that's how we grow our income stream over time. We're harvesting the gains out of the total return stocks, out of the growthy sort of stocks, reinvesting that in higher yielding shares, in bonds. If you're running a mixed asset strategy, you fundamentally expect your equities to outperform your bonds over time, which means you're consistently a seller of equities. As the equities rise, as we've done today, we've seen some huge moves in the last few months. We harvest the gains on the equity portfolio, buy those yields in the bond market. We're always naturally growing the income in the portfolio just through the nature of running a mixed asset strategy that contains a lot of growth equities, but a lot of income as well.
And these figures are made up, so anyone listening to this don't think this is correct. But if, let's say, my total return is, say, 7% on your strategy, are you kind of saying the aim is that, say 5% is income and you're seeing a little bit of growth on your fund? Because I guess a lot of people in their head, what they think is, I get 5% return, but I don't get any growth on my capital. But from what you're saying, because you think of it as total return, it's, yes, the income will dominate that, but there is that space for capital growth as well.
Well, if you think about the strategy where we sit today, we yield roughly 5. I know I can tell you the exact number today, but if we're yielding roughly 5 and inflation's roughly 2, we should be expecting a total return on the portfolio of around 7. because we need that 2% to grow the income over time. So that math you do there is absolutely correct. Is it plausible, given where bond yields are, given where equity markets are, so on and so forth, that total return is plausible? Yes. And that's what you should be seeing. You should see your capital and your income roughly grow in line with inflation over long periods of time, if we're doing our job properly.
And I guess that's such a nice way to kind of go into these kind of final questions. Is reframing how people look at it and reframing how they think about an income strategy, is that it is not just income. It's there to provide, yes, it's there to provide income, but there will also be capital growth as well. And that's what the long-term aim is. I'm switching it around a little bit, is that if someone is planning to retire, let's say in 3 to 5 years, and they're considering an income approach, again, I'll use the term natural so people can see where I'm coming from, is there a kind of sensible action plan to doing that? Should they, without asking for advice, or, I guess do people start to move into that gradually, or do they just get to, 5 years time and then they just go, yeah, let's do it?
No, I wouldn't suggest, the precipice approach is a good idea. We have a lot of advisors actually who transition their clients in the years running up to retirement into income strategies. And there's some huge benefits you get from that. The biggest benefit is, in my view, the client experience and client journey that you receive in that environment. If you were just to wake up one day and say, oh, I've retired now, please IFA sort me out, your outcome is going to be very much dependent on what yields are, where markets are, where annuity rates are at the time. And you don't want that. If you're in the run up to retirement, in the run into retirement, and you're moving across to income strategies, firstly, the client sees how much his portfolio is capable of delivering him in income terms, and a lot of clients, by their very nature, the fact they've taken financial advice, the fact they've saved, they're going to be the conservative sort of people. That just goes with the territory. And they're going to be worrying, am I able to retire? Can I actually live the lifestyle I'm hoping to live post-retirement? By moving them over to income strategies, you can just show them on the valuation, this is how much income your portfolio generates. That shifts the focus away from markets, which can be very volatile. Because even if capital markets are swinging around 20% either way, the income on the portfolio is not. And so they're able to see, look, actually, no, I don't need to worry. Oh, the FTSE's up, the FTSE's down. I'm watching the BBC every day, whatever. This is unhelpful and unhealthy. If they're able to, the advisor's able to say, look, every month your portfolio generates you this level of income. You're able to, you don't need to worry so much. Keep making the contributions, but you're in a position you can retire on this level of income already. Then, of course, because they're not retired and they're still making contributions, their income is growing really attractively. It's compounding up each year. They're reinvesting the income, so they get growth in the income stream, irrespective of what happens. They'll reinvest the income stream will grow, and they can see themselves rapidly moving towards that retirement income target that they're getting, rather than saying, oh, well, we hope you'll be able to draw 4%, your market's down 20% this year, so your retirement income's now 20% each year. They're just focusing on the income stream. Those conversations are much better with the client.
And I'm not sure this question is easy. I mean, that's really interesting. It's kind of that transition is really important. Do you know any research or anecdotal evidence that retirees who rely more on income versus drawing capital feel more emotionally secure, even if the maths works out similar?
Yeah, I believe that's the case, actually. I believe there have been studies that show that, actually. And you can just think about in your own personal experience, it always feels better if you're spending an income rather than selling something. It clearly does. Selling something to spend the money is a very different feeling than spending income. And understanding the distinction between the two is quite powerful. And I believe there was a recent, I think it was in the States, but there was an academic study that asked an awful lot of people. And clearly that the cohort that's just living on natural income is a happier cohort. And I throw in another point, actually, which is we tend to think of it as a strategy that's appropriate for pre and post retirement. On a personal note, I put my son's junior ISA into my fund, mainly because it seemed like the best idea, keep it in the family. But actually, even from his point of view, when I show him his valuation and tell him, oh, did you know you received this much income last month out of your investments? Oh, can I spend it? No, you can't. No, you're going to reinvest it. But I put him in the income units. But throughout the investment journey, throughout your life stages, knowing that you're moving ever closer to whatever your near, medium-term, long-term life goals are, through just receiving the income on a portfolio, it's a powerful emotional difference than, oh, I really hope Nvidia goes up tomorrow because I lost so much money yesterday. Mm. What's a better emotional state to be in? I mean, I can't.
I think that's so powerful, isn't it? It's to see that natural income and just be able to see that income coming in and know that you're spending it out of something that is being given to you effectively. Two more questions I've got because I've taken so much of your time. If you could bust or break one myth around retirement income strategies, what would that be?
It fundamentally is that you're foregoing total return. I absolutely is not the case. And, just look at the medium-term, long-term track records of the well-managed mixed asset income funds, and you'll see that they can well keep up, if not considerably beat other similar strategies at a similar risk profile. You don't have to give up total return. You do not have to ignore where the returns are in financial markets. You do not have to take more risk. You should be taking less risk. You should be adequately diversified, and you should be able to grow that income stream doing the job properly. And there's a worthwhile number of funds out there that have demonstrated that an income strategy can be at least as good, if not better, than the vast majority of growth strategies.
And then finally, and I know you've kind of talked about this quite a lot throughout this, but I think it's quite a nice way to sort of wrap it up. For someone who is obsessing over how to take income from their investments, what's your one piece of advice?
Take financial advice. Honestly, I think most people really need financial advice. You might say, oh, I'm singing to the audience and so on and so forth, but absolutely not. I know so many people in my personal life who have failed to take financial advice over the course of their careers, who are now faced with challenges that they didn't need to be faced with. So whether it's how to take income out of a portfolio you've built up over time, so on and so forth, take financial advice, go to the experts, and expect those experts to go to the experts in solving that specific problem that you have. And we're in a world where far too few people do that. Far too many people are winging it, guessing it, hoping that they know the right answer. And the level of knowledge that the advisory community has is just tap that expertise. It's worth every penny.
And I might as well ask, as this is kind of the end bit that you said, do you have a financial advisor yourself? Or because I kind of think if you know it, or you don't really need one.
No, I know about investment. I do not know. I do not know. No, I absolutely have a financial advisor. Absolutely. And they do a cracking job and keep me on the rails. And they actually look after, I suppose, a considerable amount of my net worth as well. The bit that isn't invested in my own funds. But, I rely on them for all the bits I'm not good at. There's the planning bit, there's the complexity of tax structures, of how to structure your investments, so on and so forth. This is well beyond the expertise of one man who's good at running an income fund, And too many people in financial markets think, because I know about stocks and shares, I don't need a financial advisor. Or for goodness sake, this is a tiny portion of what your financial advisor does.
And that's such a powerful way to end this is like, and I think you're right, is that there's this kind of feeling that if you do it yourself, it's all about the investment. But as you've kind of demonstrated throughout this, it's so much more complicated, how much you withdraw, what strategy you go down, and almost kind of reframing, how to deliver that sustainable income. And I just think what you've said today has been really, really interesting. For me, it's been insightful. I think refreshing as well. Is that, I know that there's that kind of natural tilt towards kind of natural income. I like the way that and I've never really thought about it, is that we talk about natural income, but we didn't used to. You didn't say it was the XYZ natural income fund. You just said it was the XYZ income fund. But I guess that's how we've kind of moved. At this rate, the way that things are changing, we might have to do this again next year and get your views again. But anyone who's listening, I will put some links to Premier Miton, to the income strategies, and I know that there's some really good material on there as well. I'll also provide a link to the book. And so first of all, I'd just like to say thank you, David, for joining us again. I really appreciate your time.
It's always a pleasure, George. Always a pleasure.
Thank you. And anyone who's been listening, thank you so much for listening. And obviously, if you enjoyed the episode, please rate, review, share. It helps us grow the audience and hopefully bring more conversations like this to you. So I really appreciate that. And thank you very much. Thank you, David.
Cheers.